If you're following our Global Economic Outlook series, hit subscribe to stay updated with new country releases. Singapore's Q2 2025 results reveal something extraordinary. GDP growth in the mid-single digits, unemployment at just 2.1%, and inflation under 1%. But how did this small, open economy navigate global headwinds? The answer lies in 5 key economic pillars. First, GDP annual growth rate strengthened in Q2 2025. Year-on-year expansion around the mid-single digits. After a strong finish to 2024, early 2025 readings showed sequential improvement, reversing a mild soft patch in the first quarter. Activity gains were driven by non-oil domestic demand, a pickup in manufacturing exports, and stronger services receipts. Second, the unemployment rate remained very low, near about 2.1% in Q2 2025. Labor market conditions were tight across skilled services, finance, and logistics. While youth unemployment stayed contained, employment growth was supported by hiring in financial services, hospitality tied to a tourism recovery, and construction linked to ongoing infrastructure projects. Third, interest rates in Singapore were relatively low by global standards, with short-term market rates and SORA averages near 1 to 2% in mid-2025. The Monetary Authority of Singapore continued to use an exchange rate-centered monetary framework, adjusting the currency policy band as needed to balance price stability and growth. Market participants signaled a gradual easing bias in monetary conditions as inflation moderated. Fourth, inflation was subdued with headline consumer price inflation around under 1% in mid-2025. Disinflation reflected lower import prices and moderated domestic energy and food costs. Core inflation remained modest, helping preserve real incomes, and supporting steady household spending despite moderate wage growth. Fifth, public finance and debt indicators pointed to manageable positions. Government bond issuance increased in early 2025 to support targeted infrastructure and productivity initiatives, but debt servicing remained sustainable relative to strong fiscal buffers. Household indebtedness, measured as household debt to GDP, was elevated compared with regional peers, yet showed signs of stabilization and prudent credit management by banks. Sectoral performance underscored the economy's stability. The services sector, including finance, professional services, tourism, and transport, delivered steady expansion and accounted for a major share of employment and value added. Manufacturing registered pockets of strength in electronics and precision engineering, supported by robust global tech demand and stable export orders. Construction activity received a boost from both public infrastructure and private development projects, adding to domestic demand and labor absorption. External accounts continued to support resilience. Exports rebounded in the first half of 2025 while imports eased, improving the trade balance and creating a modest positive contribution from net exports. Tourism receipts recovered as international travel resumed, contributing to foreign exchange inflows. Strong foreign reserves and external buffers underpinned confidence in monetary and exchange rate stability. Financial system metrics remained healthy, non-performing loan ratios were low, bank capital adequacy stayed strong, and liquidity conditions were ample. Credit growth to corporates supported investment in productive capacity, while consumer credit expansion remained moderate and aligned with macroprudential guidance. Key risks to the stable outcome included global trade tensions, a potential slowdown in major advanced market economies, and volatility in demand for semiconductors and high-tech goods. A sharper-than-expected swing in global demand could transmit quickly to the export-oriented economy. Domestically, elevated household leverage and any abrupt rise in borrowing costs could dampen consumption and sentiment. Policy considerations to sustain stability emphasized calibrated fiscal and macroprudential measures. Fiscal policy focused on targeted spending to boost productivity and skills, while avoiding broad stimulus that could reaccelerate inflation. Macroprudential tools aimed to contain household credit risks and ensure responsible mortgage lending. Authorities prioritized investments in digital infrastructure, green technology, and workforce skilling to raise long-term potential growth and diversify high-value sectors. Business sentiment and leading indicators suggested cautious optimism. Purchasing manager indices in services and manufacturing hovered above neutral. Capacity utilization ticked up modestly, and investment intentions were cautiously positive, particularly in logistics, data centers, and advanced manufacturing. These indicators suggested the economy could maintain a steady course through the remainder of 2025, provided external conditions did not deteriorate sharply. Looking ahead, policymakers faced a trade-off between guarding against imported inflation and supporting a gradual normalization of monetary conditions. The exchange rate-centered framework provided flexibility to lean against imported price shocks, while allowing domestic interest rates to follow market developments. Continued vigilance over household credit trends and housing prices remained important to avoid financial stability vulnerabilities. In summary, Q2 2025 presented a stable Singapore economy characterized by solid GDP growth relative to many peers. Ultra-low unemployment near 2%, subdued inflation under 1%, modest market interest rates around 1 to 2%, and manageable public finances supported by significant buffers. The combination of external resilience, a flexible policy stance, and diversified services and manufacturing sectors helped Singapore navigate a complex external environment, while preserving domestic stability and supporting steady growth. To reinforce stability and promote inclusive growth, recommended policies include expanding vocational training, incentivizing higher value-added manufacturing and services, accelerating green investments, and improving access to affordable housing. Strengthening regional trade partnerships and digital trade links will reduce exposure to single market shocks. Continued collaboration between government, industry, and academia can hasten technology adoption and skills upgrading. Maintaining vigilant macroprudential supervision alongside targeted fiscal support for productivity projects will keep inflation contained while boosting potential output. Overall, if global demand remains steady and domestic policy stays calibrated, Singapore is well placed to sustain stable growth through the remainder of 2025 and into 2026. Policy flexibility will remain important going forward. The Singapore economy has demonstrated remarkable resilience in navigating global uncertainties while maintaining domestic stability. With unemployment at 2.1%, inflation under 1%, and GDP growth in the mid-single digits, Singapore's Q2 2025 performance sets a strong foundation for continued stability. The key will be maintaining this balanced approach while remaining vigilant to both global developments and domestic vulnerabilities. As Singapore moves through the remainder of 2025, the combination of prudent policy management and economic diversification positions the nation well for sustained prosperity. Singapore's Q2 2025 economic performance demonstrates that strategic policy management and economic diversification can deliver stability even amid global uncertainty. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.